Target is down 19% year to date, which has significantly underperformed the S&P 500, which is up 15% year to date. So is Target Corporation severely undervalued at the 52-week low with a yield of 3.61%? Today we're going to find out, is Target a buy now? Can we buy this at an undervalued price? Is it undervalued? And with the yield of 3.6%, can we get that yield on cost to double digits over the next few years? We're going to take a look at the historical performance of Target. We are going to look into their financial statements, look at their revenue growth year on year, as well as touch upon that bottom line, that net income, how that has grown over the last 5 years. We're going to look at the health of the balance sheet, look at their total cash versus their total debt. And this is then going to in turn look at the dividend safety. How safe is that dividend? Look at some very important financial metrics for Target. And as always, we are going to run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, it's down 19% year to date. It is there right there towards the 52-week low. And as we can see, a forward yield of 3.61%. Now, is this severely undervalued, or is this a company that is heading into a decline, and are we catching a falling knife? Well, over the last 10 years, in terms of performance, you would be up 92% without dividends reinvested. Not the worst, but also not the best. We want to be looking at companies where we can see growth of 200-300% without dividends reinvested. Now, what we want to understand here is the point right now that we're seeing $123, an entry point where we can see significant growth on your yield on cost. So jumping straight into the financials of the company, revenues, we'd like to see between 3 to 7% growth year on year. February 2019, $75 billion on that top line. January 2023, $109 billion. So some very nice growth over the last 5 years on that top line. And included within that, we can see consistent growth year on year. And we will shortly look at the 10 years growth in percentages. Now, the bottom line, how does that follow the top line? Well, February 2019, $2.9 billion on that bottom line. Zoom 5 years fast forward, $2.8 billion. So in fact, it has remained relatively flat over the last 5 years. And when we look into the granular detail, what we can see, in fact, February 2019, $2.9 billion, up to January 2022, $6.9 billion. So we can see it has increased. However, January 2023 in the annual report, it has dropped significantly, with a large portion of that from what Target blamed to be theft and shrinkage. So we'll touch upon that very soon. Now, in terms of the balance sheet and the health of the balance sheet, well, total cash versus total debt, what we can see, February 2019, $1.6 billion in cash. Latest quarterly report announced a few weeks ago, $1.6 billion. So they have increased their cash on their balance sheet, very minuscule, but it is slightly higher than the last 5 years. Now, how does that compare to the directional movement of the total debt and the actual amount? Well, what we can see here, the total debt, 2019, $13.4 billion. It has increased quite significantly to around $19.3 billion over the last 5 years. So they are increasing their total debt, whilst I would say keeping their cash balance relatively flat. Now, how does that affect essentially the dividend safety? Well, they have a dividend safety score of 90, making them very safe. Market cap, $56 billion, making it a large cap company. Now, for those who believe we're heading into a recession, or we are currently in one, how did they perform in the previous 07-09 recession? Well, they increased the dividend, which is good news for dividend investors. Their sales were essentially flat. However, this was above the average growth rate during the 07-09 period, which was negative. However, the recession return, interestingly, was negative 61%, which trailed the S&P 500's negative 55%. So quite a bit there to digest. Now, in terms of their annual dividends, first thing to note, 51 years of consecutive increases. Now, why is that something to pull out from here? Well, if a company has paid increasing dividends over the last 50 years consecutively, they are a status of dividend king. So Target are in fact a dividend king. Their latest increase, 1.9%, very poor in my opinion, a few months ago. Why is it poor? I always say minimum of 4% increase due to inflation in the US being 4% over the last 40 years. Anything less in your salary, other income producing assets, or dividends, you are taking a pay cut and losing your purchasing power. However, on a positive note, the last 5 years, double digits, 10% increase. Last 20 years, double digits, 15% increase. So it is positive to see, but the question remains, will they be able to continue those double digit increases that we have seen over the last 10 years? Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. What we can see here, one sign of undervaluation. However, as always, we never look at any model in isolation and draw our conclusion towards the end of the episode. Forward PE, 14.5 versus the 5-year average of 17.3, another sign of undervaluation. Likewise, the sector PE being significantly higher than the current PE, a third final indicator of undervaluation. As always, though, we never conclude based on models in a singular aspect. 52-week price range, while I did mention it is towards the 52-week low, it doesn't mean undervaluation. Exactly the same, 52-week high would not signal overvaluation. Now, for investors that are new to the channel, we typically look at the free cash flow payout versus the earnings payout, as the earnings is susceptible to manipulation by management through accounting. So free cash flow, what I like to look at is around 60% and below. Why? Because it essentially means that the company is able to increase their dividends double digits that we love to see as dividend growth investors. So 2014 to 2022, very positive, below that 60% that I like to see personally. 2023 negative, and we'll touch upon that shortly. However, 2024 is expected to be around that 60% mark that I like to see at the upper end of the threshold. Now, in terms of the earnings per share versus free cash flow per share, I do keep the earnings data available on screen for those investors that do like to see that. However, again, I only like to analyze the free cash flow. 2014, $7.30, 2022, $10.40. What we can see in 2023, they are in fact negative $3.27 of cash flow per share. So they are in fact losing money, as we can compare that and see that in terms of the payout ratio. As we can see, why here 121%. So you never want a company to have their free cash flow per share negative. You always want to see continued increases over the time period. So this is one thing to note. And you would need to see the 2024 data to see how they're expecting to turn that around. Whilst it is positive that it is expected to be 776, one thing to note is just to understand how management are able to effectively perform as their estimates. Now, sales growth and total sales, as I mentioned, 3 to 7% yearly growth is what we like to see. But if we take a look 2014 to 2020, in fact, it has been at the lower end of that we like to see as investors. 2021, however, double digits. 2022, double digits again. 2023 has slowed down. Again, it doesn't give me massive faith looking at the sales growth, but this is only one part of the analysis that we like to look at. Numerically speaking, 71 billion in 2014, 109 billion in 2023. So whilst there has been an increase over the last 10 years, we can see it has remained relatively flat from 2014 to 2020. So something to bear in mind as a potential investor. Now, shares outstanding, we love it. Essentially, as investors, when companies do share buybacks, returning excess cash to our shareholders. 642 million shares outstanding in 2014, 465 in 2023. So they are a company that do share buybacks, and as we can see, that is very positive. So that is one thing where I would say for Target, there is a green tick next to their name. So that is positive to note, as we do see some companies that do have their shares outstanding flat, or the opposite, which is much more negative, where it is essentially upwards and they are essentially diluting your ownership as a shareholder. ROIC, return on invested capital, one of my 7 golden dividend metrics. Check my pinned YouTube video to see the other 6. Around 10% plus is what I like to see, as it means management are effectively able to allocate their capital. Very positive here, all above 10%. However, from 2022 to 29%, it has dropped to 2023 data at 12%. So again, something we should keep our eye on in 2024, as we don't want that dropping below 10%. Operating margin and free cash flow margin. Well, we can see here one of the issues that Target are having. Their margins are dropping. We can see that from 2022 at 9%, which is significantly lower than our 10% on average, between 6 to 9% over the last 10 years. And then 2023, we see that drop to 4%. The lower the operating margin, the lower that bottom line net income is going to be, and the shares and dividends that the company are essentially able to either buy back or essentially pay as dividends. Free cash flow margin, again, we can see very inconsistent around that 6% we like to see. 2019, 2%, 2022, 4%, and 2023, negative 2%. Now, net debt to earnings for interest, tax, depreciation, and amortization, something that I did mention in the balance sheet with that increase in total debt level. However, we do like to see this below 3. What this means, 3 years for the company to pay off all their debt net of cash on hand. 2022, it was 0.85 years. It did increase dramatically in 2023 to 2.4. However, it is expected to drop below to 2 in 2024. So again, just something to note, it is still below the threshold, but it has increased, so we would like to keep that number as low as possible. And here, purely information purposes, 60% of the company's financing in 2023 was from debt as opposed to equity. As always, if you are enjoying the content, do hit that like button, do subscribe to continue be notified of these reviews being dropped on the channel. And if you do want to run your own company through the valuation model, do grab a copy in the pinned description below. Now, starting off with Graham's valuation, we have the ticker symbol for target, the earnings per share, growth rate per analyst estimates of 19 forward looking, with that current yield on AAA corporate bond at 4.99. This gives an intrinsic value of target $167. When we take a look, some significant upside to the current trading price and just below that 52-week high. Then we move on to the multiples valuation model, companies in a similar sector and size, Walmart, Kroger, Dollar General. We have their stock price, EPS, and the PE multiple. We multiply the average by the earnings per share of target, giving a stock price of $142. Again, significant upside to the current trading price and within the 52-week range. Then on the third model, the dividend discount model with our yearly dividends, the growth rate on average around 12%. Very nice to see over the last 5 years. We can see that 20%. However, it did then drop to below the inflation. Forward looking, I've gone 4.5%, slightly higher than the inflation rate and significantly lower than the average growth rate. You could justify a higher figure. You could also justify a lower if you want to be on the more conservative side. So if you do want to play around with these numbers, do check the pinned comment and grab a copy. However, based on the estimates and judgments of this video, the DDM price comes to $131. A little bit of room there for growth from that current trading price. We then move on to the discounted cash flow model with the free cash flows year on year. Average growth rate is 16.9%. Forward looking, analysts estimating around 3 to 4%. So again, I've gone more conservative. With the discount rate at 8%, the present value of future free cash flows and terminal value are summed together. With cash, subtract the debt and arrive at our equity value. Divide that by the shares outstanding, we get a DCF price of $164. Again, showing some nice upside to that current trading price and within that 52-week range. Now, the intrinsic value is essentially the average of the 4 models that we have just calculated and gone through now. And as always, if you are enjoying the content, do hit that like button, do subscribe to join this lovely community. Now, intrinsic value coming in at $151. Current trading price at around $123. Now, typically margin of safety, 10%, strong financial metrics, wide moat, good forward-looking data, $136. Personally, for target, I would be looking at a higher margin of safety. I think you could probably justify 15 to 20%. 15% margin of safety, your acceptable buy would be around $128, making it a buy now. 20%, your acceptable buy would be around $121, not really far off the current trading price. Now, Wall Street do forecast the price to look, well, essentially $150, which is right there, our intrinsic value calculation. So what this data means is that if you were to lock in a price on target around $121, based on the data, you'd be getting a margin of safety of 20% with upside to $150 on the current trading price. So as always, let me know your thoughts in the comments below. Are you looking to buy target, looking to sell, or purely on the sidelines speculating? As always, don't forget to like, subscribe, catch you on the next episode, and have a lovely, lovely day. Take care.